Hi, this is Michael King. Welcome to Corporate Finance Basic Concepts, Part 2. We're going to pick up where we left off by talking about the goals of the corporation. We're going to look at the principal-agent problem, and we're going to talk briefly about finance careers. So there are many different potential goals for the corporation, and as I pointed out last class, the one that most people used to associate with the sole goal of a corporation was maximizing profits to increase shareholder value, or the two bubbles at the top. But now we're seeing more and more corporations are being held to a higher standard where they have to be responsible not only to society as a good corporate citizen or to the communities where they're based, but also they have to maintain an orientation of looking after the environment and keeping their customers satisfied. We call this stakeholder capitalism. Another way of describing this is as the triple bottom line, where a corporation has to be concerned with the 3 P's: people, profit, and planet. So the goal of the corporation used to be, and some would argue was always a mischaracterization, was maximizing shareholder value. What happens when you have a corporation is that you may have managers who are running the corporation that are not shareholders, in which case the managers are not necessarily aligned in terms of pursuing the interests of the shareholders. For example, managers may take day-to-day decisions that will increase quarterly earnings with a focus on every quarter's report, leading them to be more risk-averse and conservative, whereas shareholders may want to see the share price increase over the long run and want to see them taking longer-term investments and taking on more risk. We talk about this problem in corporate finance a lot. We call it the principal-agent problem, where shareholders, or the owners, are the principals, and the managers who are employed by them are the agents. Now, it's not always the case that the managers don't own shares. When a founder of a company, such as a Bill Gates or a Michael Dell, can be a major shareholder, they may be the principal as well as the agents, in which case their interests are aligned. But in many publicly listed companies in North America, we see that we have professional managers that have very little or no shares in the company. Now, these managers may take decisions that benefit them at the expense of their shareholders. For example, paying themselves high salaries and bonuses, making only safe investments, as well as consuming perks, such as buying a corporate jet or running up their expenses. They may also take decisions that create negative externalities, such as creating pollution, providing an unsafe workplace, or leading to labor unrest and strikes. There are some cases where managers will take criminal actions, and we've seen this in both the financial industry as well as the non-financial industry with high-profile cases such as Enron, where managers have evaded taxes or engaged in fraud. Now, this agency problem arises because the interests of managers and the interest of the equity holders may not be aligned, and we call this problem the moral hazard problem. What this means, in more generally, is that people may change their behavior if they're not responsible for bearing the consequences of their actions. So here we talk about agency costs, where on the left we see what the worker wants to do, and on the right we see what the shareholder wants. There tends to be 2 different types of agency costs, direct and indirect. So direct agency costs are when a manager takes decisions that are less than optimal for maximizing shareholder value. Indirect costs are the costs that are involved with monitoring managers through supervision, through contracting and compensation structures. So a classic way to align the interests of the agents with the principals is through executive compensation. And we can see here, for example, that in some cases, here we have the top 5 highly paid CEOs from 2018. The Canadian Business is no longer reporting this list. You can see that, for example, the CEO of Valeant Pharmaceuticals, Joseph Papa, He earned a total compensation of $83 million, of which $81.8 million was in the form of bonuses, pension funds, and long-term incentive plans. So those large bonuses may actually lead to risk-seeking behavior that is suboptimal for the shareholders. So there's a whole area of corporate finance which is only concerned with this principal agent problem. It's called corporate governance. So corporate governance is about how to solve this problem by putting in place principles, policies, and procedures that clearly define responsibilities and hold accountable the senior managers as well as other employees. Some examples of corporate governance measures would be having a board of directors that supervises management, using employment contracts and compensation designed to align interests, such as paying with stock where the stock vests over a long time horizon, as well as using market forces to discipline management, such as having the potential for takeovers or having activist investors that come in and scrutinize and potentially stage a campaign to fire the CEO. So there's lots of different potential careers available in finance. Within the corporation, you obviously have the chief financial officer, the treasurer and controller, as well as other members of the team. We talk about the buy side and the sell side, where the buy side are people who are actually acquiring securities, both debt and equity securities of corporations. And you may be in a buy side firm, such as an asset manager, where your job, say at BCI, is to be the portfolio manager, actually investing the money. You may be the trader, where you're making a market and buying and selling in securities, as well as in other financial assets, such as foreign exchange. You may be a financial analyst, where you write an equity report on the company or analyze its debt. You could be a risk manager, or you could be an economist. There's many different roles on the buy side, and they may be at many different types of financial intermediaries. Pension funds, hedge funds, investment banks are 3 examples. We also have the sell side. Now, the sell side are people whose job it is to sell financial securities coming from either a corporation or a government to individuals, institutional investors, corporations, and to government. So we think of bankers as being on the sell side, commercial and retail bankers, as well as investment bankers. We think of sales and trading within an investment bank. We have equity analysts, brokers, asset managers, and private bankers. Many different types of sell-side positions. A final area is actually the public sector and other types of jobs. So you could work for the finance ministry in the country, in our case Finance Canada. You could work at the central bank, such as the Bank of Canada, where I also worked. You could work for the supervisor or regulator, such as the Office for the Superintendent of Financial Institutions, or at the provincial level, the BC Securities Commission. You could also be a policymaker of some type, or an academic, such as myself, a journalist. There's many different types of jobs involved with finance. If you're interested in any of these, please let me know, and I'd be happy to talk about them more. That's it for today. Thanks for your attention.